Hi, Matt McAleer, Director of Equity Strategies, June 19th, just after the close. What are we seeing this week? What are we feeling the market's trying to tell us? Well, a little bit of a change in the equity market this week in that up opens got sold. A little bit different from the previous 7 or 8 weeks when the market would open up and keep going. Here, futures strong overnight, futures strong pre-open, market would open up. That tended to be the high for the day. So those prices were pulling in supply. A little bit different. Not a problem, just a little bit different, something to notice, something to register in our analytics. Between 30.50 and 31.50 in the S&P, a good little battle going on between supply and demand. What's working and what's not working? I put together a little chart for you to take a look at, something we look at on a daily, weekly, monthly basis. And what you're looking at here is a relative strength chart in both domestic equities and international equities. Green means good. Red, there's a problem. So if we start at domestic equities, that upper box, you can see cap weighted versus equal weighted continues to be strong. Cap weighted would be an example of the S&P 500, SPY. Equal weighted S&P 500 is RSP, where each of those 500 companies have an equal weighting in the basket. We know cap weighting's been strong now for some time, continues to be strong. And that second row there, large cap growth, still the leader. We've talked about that for months now, year and a half now since we've been doing these videos. But what jumps out at me? Take a look at number 2 there, mid-cap growth. Mid-cap growth has closed to be the second strongest area in terms of relative strength. Have to pay attention to that. Followed closely by small cap growth. What is that telling us as money managers? Growth, growth, growth. While value has had a bounce, it hasn't been enough to overtake any of the growth features in terms of relative strength. Doesn't mean you can't make money in value. It still pays for us to be allocating to growth. If we go down to the third row, this gives you an idea of what's working from a sector standpoint. Energy may shock you when you see that. Some things can be a bit deceiving. One of the reasons that energy is the strongest relative strength sector right now are the alternative energy baskets or ETFs. Solar, wind, even water, hydropower to some extent, which is picked up in PHO, FO. We own 3 of those alternative energy sectors in our US ETF. TAN, which is solar, FAN, which is wind, and FO, which is water. Funny enough, that solar holding, TAN, has a good dose of semiconductor stocks in it. Therefore, picking up a heck of a lot of that strong tech strength. So underneath that energy piece is a real bid in alternative energy. And you see technology's number 2. You know, tech isn't going anywhere. It may next month, it may fall the month after that. Why guess? Why guess when we can keep an eye on what's working day to day, week to week? These sectors can't move up or down without leaving a trail, without providing us with an analytic to show there's a buy or sell between them. So right now, where new money wants to be focused continues to be in those green areas. Tough to make money in the red areas. We try to keep it simple. Green means go, red, stop or at least be cautious. Let's bounce down to the international equities. By the way, you notice that international, the big block is red versus domestic being green. Simple enough. U.S. equities are favored from a relative strength standpoint against international equities. That doesn't mean we can't find things to buy in international. Let's take a look at what's working. Green, Asia Pacific developed. Well, we know Taiwan's trading within a stone's throw of its 52-week high. Japan, very solid. Europe, developed. Right behind Asia Pacific. We've had a heck of a move out of Germany. Nice move out of another one of our holdings, Switzerland. Some very solid European action. If we move to the right there, you see areas that, while not green, are still performing decently. And those score numbers on the bottom, we don't have time to get into it today, but maybe we will in a future video. The closer the scores are, or the buy signals are, the closer the performance is between the sectors. They're registering a more narrow differential between these regions, sectors, countries. So in terms of sharing this chart with you, it was just something to take a look at. I wanted to give you a little picture of what we look at on a daily, weekly basis in trying to come up with allocations that make sense in our U.S. portfolio, in our international portfolio, and in our tactical trend portfolio. Stay with us for John Mousseau's video on fixed income, and have a great weekend and happy Father's Day.
Hi, it's John Moussea. I'm the President and CEO of Cumberland Advisors. It is Friday afternoon on June 19th. A very boring week in the bond market when you think that there was very little movement in bonds in general. 10-year bond hung around at 0.7, right where it ended last week. 30-year bond was around 145, right where it ended last week. Some movements around those areas during the week. Tax-free bond yields on the AAA scale, probably 20 basis points cheaper than Treasuries. That reflects the strong Treasury movement of last week when we saw the equity market sell off somewhat. Some recovery there that my colleague Matt will be talking about. I think the real story this week is really in two places. Number one, we saw an infrastructure bill proposed for Congress by the administration. It has some very interesting parts to it. It's going to include infrastructure aid into things like airports, toll roads, stadiums, convention centers, things of that nature. Very important. It's also got a provision to bring back Build America bonds. We remember those bonds from 2009 and 10, where you had about $187 billion issued over about a year and 3 quarters. That allowed municipalities to issue bonds in the taxable bond market, but with a federal subsidy. They had to be for new projects, so think about an airport building a new runway, a state university building a new dorm, projects where you're pouring concrete, hiring people. That's the nature of the stimulus. That's why they're bringing it back. We don't know the particulars of any subsidies yet, but we will certainly try to find out more. The second part of that program is to allow municipalities to resume doing advance refundings. These were taken away with the 2017 tax bill, and it's very simple. It allowed municipalities to sell tax-free debt and defease older, higher coupon debt. So they'd sell debt, buy treasuries, set them aside, pay off the old bonds at the first call date. It was a great way for municipalities to lower their debt service cost. And as they come out of the pandemic, anything that will lower the nut for whether it's a state, a county, or a city is very important. So we think that's a very good provision in it. We've thought and have talked about bringing back advance refundings because it really doesn't cost the federal government that much money to do that. So that's a positive. Another thing that we saw this week in the bond market, we saw American Airlines through the New York Industrial Development Authority sell basically $300 million of bonds for the airline. They're 10-year bonds. They averaged about 5.5% tax-free, B-rated, B-minus rated, bonds that we do not buy at Cumberland because of the risk factor. But here's the thing that was interesting. You had a deal that was originally $100 million. It was up to $300 million. They had orders for $4 billion in bonds. So that says something. Here's a very troubled part of the economy, right? Airlines. And no trouble selling $300 million of bonds at what are extremely attractive yields, clearly, with a lot of risk to them. But they were clearly gobbled up too. So access to capital markets still in place. Very important for corporations like American Airlines, very important for municipalities as we move forward. That's the wrap on bonds for this week. We look forward to wishing you a very good week and see you next week. Thanks.